If I had to start investing today from scratch, knowing what I know about the AI boom, the valuation problem, the Fed, inflation, and the way Wall Street sells certainty when the future is anything but certain, I would not begin by asking which stock can double. I would not begin by asking which analyst has the biggest price target. And I definitely would not begin by asking whether this market feels exciting. I would begin with one question: what is already priced in? Because that is where people get into trouble. They hear a huge forecast. They see a chart ripping higher. They watch a famous tech analyst say AI is still early, and suddenly they think the only risk is missing out. But the real risk is different. The real risk is being right about the story and still wrong about the price. Today is Sunday, May 3rd, New York time. Comment what day and date you are watching from, because the market changes every week, and your emotions change even faster. And if you value this kind of clear market breakdown, subscribe and comment John A.G. Best below. It helps support the work and tells me you want more calm thinking, not just louder predictions. So let's walk through this properly. We just came through a market move that would make a normal year look quiet. In a short stretch, stocks swung by roughly 1/5 from panic to optimism. That is enormous. People forget this. A move that large is not background noise. That is the market repricing fear, earnings, inflation, oil, AI, and rate expectations almost all at once. And now the bulls are out. They are saying, look, earnings are not just holding up, they are strong, the economy is still moving, AI demand is still absorbing compute, big tech is still spending like the future has a toll booth and they need to own every lane. And on the surface, that argument is not silly. Based on recently published numbers, first quarter earnings growth for large American companies has been tracking much stronger than expected, with big tech doing a lot of the heavy lifting. Profit margins are also still sitting at unusually strong levels, which matters because earnings are the oxygen underneath stock prices. So the bullish case says this: if earnings keep rising, if AI keeps driving demand, if inflation cools enough for the Fed to ease later, and if geopolitical pressure stops feeding oil prices, then the S&P 500 can push higher, maybe a lot higher. Some forecasts now put the index in the upper 7,000 range by the end of 2026. That is not a small call. That is Wall Street saying the rally still has fuel. Then you have the technology bulls. Their argument is even more aggressive. They are basically saying AI is not in the final inning. It is not even close to finished. The spending cycle is still early, the applications are just starting to spread, and the companies that control cloud, chips, software, data, cybersecurity, and automation could keep surprising people. And again, part of that is true. According to recent company updates, cloud demand tied to AI is still very strong. Alphabet's cloud business just posted very fast growth, and management lifted its capital spending plans into a huge range. Meta also raised its spending outlook because AI infrastructure is becoming more expensive and more necessary. Microsoft is still showing powerful cloud momentum while spending heavily to support AI demand. This is not imaginary. Data centers are being built. Chips are being ordered. Power demand is rising. Memory prices are moving. The AI build-out has become a real industrial cycle, not just a software story. That is why Nvidia matters. That is why Microsoft matters. That is why Alphabet matters. That is why cybersecurity names matter. That is why even old companies are suddenly talking like AI is no longer optional. But here's the part most people skip. Real spending does not automatically mean good returns for every investor. In fact, sometimes the biggest spending booms create the biggest overpayment mistakes. Railroads were real. The internet was real. Smartphones were real. Cloud was real. Electric vehicles were real. But investors still lost money when they bought too much excitement at too high a price. That is the whole point. A theme can be correct, and the entry price can still be wrong. Take Tesla. The bull case is not just about cars anymore. It is autonomy, robotaxis, robots, software, energy, and maybe one day some connection with SpaceX. That sounds incredible. But incredible is not the same as cheap. If your investment case requires everything to go right, across multiple industries, over multiple years, with no regulatory friction, no competition, no margin pressure, and no delay, then you are not investing in a business. You are investing in perfection. And perfection is expensive. Apple has its own version of this. The bull case says AI could trigger a device upgrade cycle, maybe with deeper search and assistant partnerships, maybe with better on-device intelligence, maybe with services becoming even stickier. Fine. That can happen. But Apple is already one of the most studied businesses on earth. You are not discovering a secret in your basement. You are buying a company where a lot of future success is already understood. Microsoft is stronger in a different way. Cloud demand is visible. Enterprise customers are locked in. AI tools can be layered into products businesses already use. That is powerful. But even there, capital intensity matters. If AI revenue grows, but the cost to serve that revenue grows too, then investors need to watch margins, not just headlines. Palantir is a great example of the market's new imagination. Commercial AI, government data, workflow automation, decision systems, all of that sounds like the kind of thing that can become much bigger. And maybe it does. But high expectations can turn even a wonderful company into a difficult stock. CrowdStrike sits in another important lane. AI creates smarter attacks, faster attacks, and more automated defenses. Cybersecurity is not going away. But again, price matters. The market does not reward good stories forever if the math does not eventually show up. So yes, I understand the bull case. I understand why people are excited. I understand why some analysts think tech can add another mid-teens move, maybe more, before the cycle cools. But I also understand this. When the crowd starts treating forecasts like facts, your job is to slow down. The Fed is one reason. The central bank just kept rates steady, and the message was not, everything is fixed. The message was more like, inflation is still elevated, energy prices are complicating things, and Middle East developments are adding uncertainty. That matters. A market priced for lower rates does not love sticky inflation. The inflation data backs that up. The latest consumer price report showed headline inflation in the low threes over the year, while March energy prices jumped by low double digits and gasoline rose by about 1/5 in just a month. That kind of move can mess with sentiment, wallets, rate expectations, and corporate costs very quickly. So the risk is not just valuation. The risk is valuation plus uncertainty. Expensive stocks can handle good news. They can even handle okay news. What they struggle with is disappointment. If earnings miss, if inflation stays sticky, if rates stay higher for longer, or if AI spending starts looking less profitable than expected, then the market does not need a disaster to fall. It only needs reality to be slightly less perfect than the price assumes. Now let's talk valuation. The broad market is not cheap. The long-term earnings multiple is sitting around levels that history usually treats with caution, and the stock market compared with the size of the economy is also very stretched. Different models disagree on the exact level, but the message is the same. You are not buying from a bargain bin. Does that mean sell everything? No. That is where people get valuation wrong. Valuation is not a timer. It does not tell you Tuesday is the top. It tells you future returns are harder when the starting price is high. It tells you your margin of safety is thinner. It tells you discipline matters more. And this is where Buffett's behavior is worth studying, not worshiping. Berkshire is sitting on a cash pile close to $400 billion. That does not mean you should copy him and hide from the market. You are not Berkshire. You do not have insurance float, operating companies, and acquisition needs. But it does show patience. It shows that one of the most disciplined capital allocators in history is not desperate to chase every rally. That is the lesson. Not fear, patience. So what would I do if I were starting now? I would build the base first. Broad, low-cost index funds, automated buying, no drama. If you are investing for decades, you need participation. Sitting in cash forever because the market looks expensive can become its own mistake. But with individual stocks, I would be selective. I would ask, do I understand the business? Do I understand how it makes money? Do I understand what has to happen for the current price to make sense? And if the stock drops by a quarter, will I know whether that is opportunity or warning? That question is everything. Most people buy stocks like they are buying lottery tickets with logos. They hear AI, they hear robotaxi, they hear trillion-dollar market, and they start imagining the upside. But investing is not just imagining upside. Investing is asking what can go wrong and what you are paying to take that risk. If you're successful, share your success story in the comments so others can stay motivated. People need to see that discipline works, because online finance makes it look like everyone is either panicking or getting rich overnight. Here's the simple framework. Own businesses, not slogans. A ticker is not a thesis. A price target is not a plan. A chart is not a business model. You need to know what the company sells, who buys it, why they keep buying it, and whether the company can turn revenue into durable cash flow. Second, respect cash flows. Every investment is ultimately worth the cash it can produce in the future, adjusted for time, risk, and uncertainty. If you pay too much for those future cash flows, your return goes down. That is not pessimism, that is math. Third, stay inside your circle. If you cannot explain the company in normal language, you probably should not own it directly. You can still get exposure through an index fund. That is the beauty of broad investing. You do not need to pretend you understand every semiconductor supply chain, every cloud contract, or every autonomous driving regulation. Fourth, understand that the market is emotional in the short term and brutally practical over time. In the short run, headlines move prices. In the long run, earnings, cash flows, balance sheets, and competitive advantages matter. The hard part is surviving the gap between those two worlds. Fifth, never forget that great companies can be bad stocks at the wrong price. We saw it in past bubbles. We saw it with companies that genuinely changed the world. The problem was not that the future was fake. The problem was that investors paid for too much future all at once. So yes, 2026 may create huge opportunities. AI may keep powering profits. Tech may keep leading. The S&P 500 may climb higher. Some of these bold forecasts may end up looking conservative. That can happen. But the opposite can also happen. Rates can stay firm. Energy can squeeze inflation. AI spending can disappoint. Margins can compress. Investors can suddenly decide that perfection is too expensive. Your plan needs to survive both outcomes. So keep it simple. Automate the boring part. Study the exciting part. Do not chase every headline. Do not fear every pullback. Do not let someone else's confidence replace your own process. The goal is not to predict the next 12 months perfectly. The goal is to own enough of the future without paying a foolish price for it. That is how you stay in the game. That is how you avoid being shaken out. And that is how you turn a noisy market into a long-term opportunity instead of an emotional trap. One more thing, because this is important. Market breadth matters. When only a handful of giant stocks are doing all the work, the market can look healthier than it really is. But when gains start spreading into industrials, financials, energy, healthcare, and smaller companies, that can make the rally more durable. It does not remove risk, but it tells you investors are not only hiding in the same few mega-cap names. Still, broader participation can fool people too. A wider rally can feel safer right before expectations get too warm. So do not confuse breadth with a guarantee. It is a sign, it is not insurance. And think about the AI infrastructure trade like a supply chain, not a magic wand. Chips need advanced packaging. Data centers need land, power, transformers, cooling, fiber, and skilled labor. Utilities need to upgrade grids. Software companies need customers who will actually pay more, not just test free demos. Enterprises need proof that AI saves money or creates revenue. That is why 2026 matters. It is not just another hype year. It is the year investors want receipts. If those receipts show up, the winners can keep winning. If they do not, the market will separate the real compounders from the expensive passengers. That is usually how every boom matures. First, everything with the right label runs. Then the market starts asking who has profits, who has pricing power, who has retention, and who just had a good story. So when you hear a big forecast, do not ask, can it happen? Almost anything can happen in markets. Ask, what has to be true for this to happen? That question slows you down. It forces you to think like an owner instead of a fan. Slow, boring, consistent, and repeatable usually beats dramatic, emotional, expensive guessing over time. And please remember this, missing a hot stock is not failure. You will miss most opportunities in your lifetime. I will miss most opportunities. Everyone does. The goal is not to catch everything. The goal is to avoid the big permanent mistakes and let your best decisions compound. This is for education and perspective only, not financial advice. I am sharing how I think through risk, valuation, and opportunity so you can do your own research, build your own plan, and speak with a qualified professional before putting real money to work.